A single-member S corporation could be your path to significant tax savings while maintaining liability protection for your business. But what exactly is it, and can you really set one up by yourself? A single-member S Corp is actually a single-member LLC that is elected to be treated as an S corporation for tax purposes. This hybrid structure combines the simplicity and liability protection of an LLC with the potential tax advantages of an S corporation. The primary benefit of S Corp status is reducing your self-employment tax burden. When operating as a standard LLC, all your business profits are subject to self-employment tax at a rate of 15.3%. However, with S Corp status, you only pay employment taxes on your salary, not on distributions. To qualify for S corporation status, your business must meet several IRS requirements. Your company must be incorporated in the United States. You can have no more than 100 shareholders, and these shareholders must be individuals, certain trusts or estates, not partnerships, corporations, or non-resident aliens. Additionally, your business can only issue one class of stock. Converting your single-member LLC to an S Corp involves several steps. First, if you haven't already, you need to form an LLC in your state. Next, obtain an employer identification number from the IRS. Then, file Form 2553 to elect S corporation taxation. This form must be submitted within 75 days of forming your LLC or before March 15th of the tax year you want the election to take effect. After receiving approval, you must set up payroll since you'll now be considered an employee of your company. You'll also need to comply with any state-specific regulations, as some states require separate S Corp elections or impose additional taxes like franchise fees. One crucial aspect of operating an S Corp is determining a reasonable salary for yourself. The IRS requires S Corp owners to pay themselves a fair market wage before taking any distributions. This prevents business owners from avoiding payroll taxes by taking all compensation as distributions. When determining your salary, consider industry norms, your company's revenue and profits, the time you spend on business operations, and your skills and experience. Many accountants recommend the 60-40 rule, taking 60% of profits as salary and 40% as distributions. For example, if your business earns $100,000 in profit, you might pay yourself a salary of $60,000, which would be subject to employment taxes. The remaining $40,000 could be taken as distributions, which aren't subject to self-employment tax, potentially saving you thousands in taxes. Be cautious about setting your salary too low. The IRS closely scrutinizes S Corps for this very reason. If audited and your salary is deemed unreasonably low, the IRS may reclassify your distributions as wages, subjecting them to back taxes and penalties. Running an S corporation comes with ongoing responsibilities. You must maintain proper payroll and make regular tax filings. Many states require annual renewal fees or reports. Even as a single-member S Corp, you should keep meeting minutes and maintain corporate formalities to preserve your liability protection. You'll also need to pay quarterly estimated taxes to avoid IRS penalties. While the paperwork requirements are greater than a standard LLC, the potential tax savings often make S Corp status worthwhile for many small business owners. The sweet spot for considering S Corp election is typically when your business consistently earns more than $75,000 in annual profit. Setting up and maintaining an S Corp involves complex tax and legal considerations. Consulting with a qualified tax professional or attorney can help ensure you're compliant with all requirements and maximizing your tax benefits. They can also help you navigate state-specific rules that may impact your business. A single-member S corporation offers a powerful combination of liability protection and tax advantages for solo entrepreneurs. By understanding the requirements, properly structuring your compensation, and maintaining compliance, you can potentially save thousands in taxes while building a legally sound business foundation.